Welcome to another episode of Equity Mates, a podcast where we explore what's possible in the world of investing. If you've just joined us for the very first time, a huge welcome to our community. And for the first time in Equity Mates history, I am not joined by Ren nor another co-host. This is an Equity Mates world first. I'm going to be doing this solo. Ren is on holidays swimming with whale sharks up in Western Australia. So let's get into it.
News and markets.
So the news of the day, we're going to look at the superannuation backdown. We've got Cybertruck's sales are plummeting and Wall Street is in whiplash. Treasurer Jim Chalmers has announced major changes to the proposed superannuation tax on high balances. The key updates: the $3 million threshold will now be indexed and unrealised gains will no longer be taxed under the measure. And here's how the new structure is going to look. Balances between $3 million and $10 million will be taxed at 30%. Above $10 million, an additional 25% will be applied, bringing the total tax rate to 40%. The changes follow Prime Minister Anthony Albanese's intervention. The original proposal attracted criticism, particularly around the taxation of unrealised gains on assets like farms and family businesses. The new policy will now commence on the 1st of July 2026, which is a delay from the initial timeline. Moving to our second story, and Wall Street is in whiplash. US stocks bounced back strongly Monday, with the Dow up 600 points after Trump and JD Vance took a more chilled approach on China trade relations. This follows Friday's sharp sell-off where roughly $2 trillion was wiped off the market value after Trump threatened 100% tariffs on Chinese imports in response to China's tighter controls on rare earth exports. Tech stocks with China exposure took the biggest hit. Over the weekend, however, Trump posted on Truth Social to reassure investors, quote, "Don't worry about China, it'll be fine. Highly respected President Xi just had a bad moment." He added that the US wants to help China, not hurt it. JD Vance reinforced that message on Fox News, saying the US has leverage but is willing to negotiate if China comes to the table reasonably. Markets responded positively, reversing most of Friday's losses. This is again, though, a good reminder that trying to time the market is not the way to play this game. While China-US messaging can significantly shift market movements, stay invested, don't worry about it, and remove the noise. And to our third story, Cybertruck sales have plunged. Tesla Cybertruck sales crashed 63% year on year to approximately 5,500 units in the third quarter of 2025, highlighting a dramatic collapse in demand for Elon Musk's futuristic electric pickup truck. With the vehicle program operating at less than 10% of its planned 250,000 annual production capacity, Musk has turned to his own companies to purchase hundreds of unsold units in inventory buildup. Multiple truckloads of Cybertrucks have been spotted being delivered to SpaceX's Starbase facility in Texas and XAI offices as well. And a reminder, if you would like to keep up with all of the news headlines, make sure you subscribe to our daily newsletter where we'll send you a dot point summary of all the headlines that are important to your investing journey. You'll be able to sign up in the show notes or the description below.
Let's ask the community.
Hey, Equity Mate.
I just had a question.
Hey, Bryce, friend. I've got a question.
Answered.
We love getting questions from the community. If you would like to ask us a question, head to equitymates.com/contact. Today's question comes from Nikki.
Hello, love the show. I've got about 25K, which I want to put into a fund now and grow it as much as possible for my kids' private high school fees, so around about an 8-year timeline. I'm open to a reasonable level of risk, but would you suggest splitting it across ETFs in different regions like I would with a much longer term strategy? So currently I've got ETFs that cover Asia, Australia, Europe and the US and just dollar cost average into them each month. But I just wasn't too sure whether I should just follow the same train of thinking when I've got this sort of larger lump sum to get started. Thanks again. Bye.
Nice. Love the question. Thank you so much, Nikki. And look, this is a classic scenario which I think a lot of the Equity Mates community members face. You have a specific goal, you've got your defined timeline, which we talk about as one of the foundations of setting up your investing journey. And you're wondering whether or not you stick with your investing strategy or take a little bit more risk to accelerate reaching those goals. So I think there are a number of key considerations that you should think about when approaching a situation like this. For Nikki, the first thing is your time horizon. 8 years is actually a really good time frame, and that is because it's long enough for you to actually ride out market volatility, to be able to recover when markets crash, but not so long that you can be, reducing all of your risk. So historically, equities perform well over the 8 to 10 year period, but you will want to think about de-risking as you approach years 6 and 7 as you want to draw on that money for your kids. The second is geographic diversification is the smart way to do this. As you have Asia, Australia, Europe, it is sound, it is a shorter time frame, so you want to be as diversified as possible. And here's why. It's because different markets don't move together. You're reducing that single country risk. Like the US has been dominant recently, but that won't necessarily continue for the next 8 years. So being diversified is a super important part to this strategy. However, you could simplify it. Think about a global ETF like DHHF or VDHG, which will give you diversification across the globe without you needing to necessarily pick between multiple ETFs. And then I think the third consideration and probably the crux of this question is what to do with that $25,000. Is it lump sum or dollar cost averaging? Now, there is data that backs this up. With $25,000 to invest now, the research is pretty clear and it shows that lump sum investing beats dollar cost averaging about 68% of the time across major markets. Now, this was a study that Vanguard did across the US and the UK and Australian markets over rolling 10-year periods. And it found that investing immediately outperformed dollar cost averaging by about an average of 2.5% over 12 months. Now, you might be asking why, and it's because over a long period of time, markets trend upward. Every day that you are holding cash instead of investing, you're potentially missing out on the gains. So time in the market beats timing the market. However, and this is super important, dollar cost averaging absolutely has its place. It is the perfect strategy for your ongoing monthly contributions because you're investing as cash becomes available. We don't always just have a lump sum sitting ready to go. You're not sitting on money waiting for the time to time the market. You're investing your regular savings as you earn them each month. So it's not dollar cost averaging by choice. That's just the smart way to do investing. It's how Ren and I invest. And it's a great long-term strategy. For Nikki, the playbook is this. Lump sum the $25,000 now, general advice only, then continue dollar cost averaging with your monthly cash flow. You're getting the best of both worlds there, and as the data shows, getting that money in to work as soon as possible is the best. The final consideration that's not part of the question for you, Nikki, but is worth exploring is investment bonds. Investment bonds can be used specifically for education savings and are a popular tool to do so over a 10-year period. Investment bonds are taxed at 30% within the fund structure. So they make sense if you're in the 37% tax bracket or higher, that's earning over $135,000. And investment bonds can offer a tax advantage compared to holding ETFs in your own name, where you might pay your marginal tax rate on the distributions and the capital gains. The other benefit is the 125% rule, where you can increase your contributions by up to 25% each year. And if you hold it for 10 years, all the earnings become tax-free. So for your 8-year time frame, you won't get the full benefit, but you'd still get a lower tax during the accumulation phase. And again, I have no idea what tax bracket you are in. Fees are typically higher, but it is certainly something to consider. All right, so let's put all of this into action for Nikki. So what I would be thinking about is considering a bit of a hybrid strategy here. I'd be taking the $25,000, investing that right now across the diversified ETF portfolio that you've done. I'd either think about a global fund or the mix that you've got, maybe sort of 60%, 70% in the global fund, and then split the rest across your remaining ETFs, and then continue to monthly dollar cost averaging as your cash flows allows. Don't wait, just get your money in, automate that as much as possible. And then one final consideration is as you reach that 8-year window where you're going to look to draw on that money for your kids in high school, I would just consider the risk that you'd be taking, but safe to say with a globally diversified portfolio, I think you'll be all right. Thanks for the question, Nikki. Keep them coming in. Head to equitymates.com/contact if you'd like to ask us a question. All right, we're going to take a quick break, and on the other side, I'm going to look at how far we are away from having humanoid robots in our homes. We'll be right back. Where are we at with humanoid robots? I've been seeing humanoid robots everywhere on my Instagram lately, not sure about you. I've also been seeing a shitload of golden retriever activity now that we own a little golden retriever. Head to our socials if you would like to see more of Penny. But I've seen these robots folding laundry, organising groceries, doing household chores, you name it. So I started wondering, how close are we actually? Like, realistic, when am I getting a robot to handle my cleaning, give me a back massage just before I go to bed? So I went down the rabbit hole on where the humanoid robotics industry actually stands as of late 2025. And let me tell you, the gap between what's real and what's marketing is significant. But so is the opportunity if you know where to look. So what's actually been deployed? Firstly, let's establish what we're talking about. Humanoid robots are designed with a torso, head, 2 arms, 2 legs. They're basically human form factor. And that's not just aesthetic, it's functional. They can use human tools, they can navigate human spaces, they can work in environments that we've already built. But where are they actually working right now? Because I can tell you what, it's not my home. They are in factories, specifically automotive and heavy manufacturing. Boston Dynamics Atlas is at Hyundai's new EV plant in Georgia, sequencing car parts for automated assembly. We're talking thousands of parts being organised and prepped, not a one-off demo. This is part of the production line. Across Asia, you're seeing deployment in automotive, steel, manufacturing, and appliance production. The robots are handling repetitive tasks, physically demanding work, high-temperature environments, and jobs where the 24/7 capability actually matters. These are still pilot programs, not full-scale rollouts, but the pattern is very clear. Industrial is first, with automotive and logistics leading. So then where are we at with the home reality? That's where the disconnect really is the biggest. What you've seen on Instagram, or what I've seen on Instagram, is mostly scripted demonstrations in controlled environments, unfortunately. Tesla's Optimus can clean and tidy, but it's typically specific pre-programmed task. The general purpose home robot that can adapt to your specific house, your own mess, your own routine, well, industry estimates that that's probably 2 to 4 years out, which in the grand scheme of things isn't actually that long. And the economics are also very challenging. Early consumer units are priced between $30,000 and $90,000, and even if the technology does work, that's a significant adoption barrier for mass market. So who's actually leading at the moment? Let's get specific about who's doing what, because the competitive landscape matters here. Let's start with Tesla, Optimus. They're running internal trials across their own factories right now, thousands of units. And this is classic Tesla playbook. Vertical integration, iterate fast, drive costs down through scale. They've stated their target is sub $20,000 per unit for eventual consumer release. The robot uses advanced vision systems, sensors, and AI to handle varied surfaces and manipulate objects. And the key advantage that they have is the manufacturing infrastructure and the capital to move fast. The next is Figure AI. This is one that I've seen on Instagram a lot and one that I would love in my home. They've partnered with BMW and their Figure 02 is doing precision work in automotive plants. We're talking sheet metal insertion with millimeter accuracy. And what's interesting here is they're building towards true general purpose capability. Their Figure 03, which they're positioning for home use, is designed to autonomously handle laundry, cleaning, dishwashing, food service, even delicate tasks like watering plants, although I'm not sure how delicate that really is. They're targeting mass scale from 2026, so it is just around the corner. This is powered by their Helix AI system, which is purpose-built for humanoid control. Other players in the market, we've got Aptronic, which runs an Apollo system. They've got commercial partnerships with Amazon, Mercedes-Benz, and Walmart, and their focus is logistics and retail, loading, moving inventory, even apparel folding. Less sexy than home robots, but potentially a faster path to revenue since the value proposition for warehouses is straightforward. Then you've got the Chinese players. You've got UB Tech and Unitree. These companies are competing aggressively on price and manufacturing scale. They're already below $30,000 per unit and deploying across logistics and education sectors in Asia. The volume that they're producing is significant. Dozens of robots per site, multiple sites. They may not have the most advanced AI, but they're proving the business model at lower price points. We have Boston Dynamics. They are one of the leaders in this space. Beyond Atlas, they're the technical benchmark for bipedal mobility and agility. Their robots handle the most complex physical environments. We're talking uneven terrain, obstacles, tasks that require genuine dynamic balance, often deployed for inspection work or dangerous jobs where reliability is critical. Then finally, we have Agility Robotics. Their focus is warehouse and logistic applications, less humanoid in appearance, but similar use case, designed to work alongside humans in existing facilities. So let's talk about the market projections. How big can this get? Where it gets interesting from an investment perspective is the size of the market. Current projections put the humanoid robot market at about $40 billion by 2030 and $180 billion by 2035. That's about a 35% compound annual growth rate. Morgan Stanley's long-range forecast suggests $5 trillion globally by 2050 if adoption reaches expectations across industrial, logistics, hospitality, and consumer markets. Near-term shipments are really telling the adoption story at the moment. Roughly 10 to 18,000 humanoid robots are expected to be shipped in 2025, and we're now really starting to see an inflection point where pilots are starting to convert to serious purchase orders. However, the unit economics are improving faster than most people expected. Basic industrial humanoid robots have dropped from 50,000 to 30,000 in just 1 year, and that is pretty incredible improvement in the cost curve. But here's the math that really matters. Samsung Securities have analyzed the lifecycle cost. If a humanoid robot operates 22 hours a day and doesn't take breaks, sleep, or change shifts over a 5-year lifespan, you're looking at approximately $1.20 per hour. Now, for repetitive, round-the-clock factory or warehouse work, that fundamentally changes the return on investment calculation versus human capital. That is why you're seeing pilot programs accelerate and the business case is starting to close. Now, money is flowing into the system. Over $2.5 billion in venture capital flowed into humanoid robotics in 2024. Figure AI and 1X Technologies each raised over $500 million. And the valuations are going to companies that can demonstrate both advanced AI and manufacturing capability. For retail investors, direct access to these companies is unfortunately limited because most are still private. So, where can we actually invest in this space? Firstly, we've got the AI infrastructure providers. NVIDIA is supplying the chips and software that power these robots, from processors that go inside them to the simulation platforms used to train them. Intel and Microsoft have also invested directly into Figure AI. You've got the established industrial players. ABB is one of the world's largest industrial robotics companies and is spinning off its robotics division as a separate stock in 2026 that'll be a pure robotics play. Rockwell Automation, the ticker is ROK, is another major industrial automation company, and FANUC, the ticker is FANUY, is the world's largest industrial robotics manufacturer. Then you have the software layer. Companies like Teradyne and PTC provide software platforms that help coordinate and manage robotic systems in factories. And then, of course, don't forget broad exposure. There are robotics ETFs that invest across the entire supply chain if you want diversified exposure without actually having to pick individual winners. We're early in the infrastructure phase, just like EVs around 2015 or smartphones around 2008. The opportunity is here. You can see the trajectory, but identifying these specific companies can be difficult at this stage. Now, there are challenges, of course, with these robots, and we'll flash some up on YouTube. The dexterity for complex or variable tasks remains an engineering problem. Most current deployments require some human oversight. These aren't fully autonomous systems just yet. For consumer applications, you need safe, affordable, and genuinely useful applications. We're not there yet on all three simultaneously. We don't want a robot strangling you to death in your bedroom. Regulatory scrutiny is increasing, particularly in Europe, around labor displacement and safety standards, and that could slow large-scale deployment. And there's a gap between pilot programs and full production rollouts. Many companies are still proving reliability at scale. So here's where we are actually at. Human robots are moving from research labs into real industrial applications. The technology is advancing, costs are dropping, and capital is flowing in. The market structure is starting to look like other major platform shifts that we've seen before. But this is still early, still volatile, and definitely overhyped in some corners. The investment opportunity is significant and real, but it's about finding the right exposure, whether that's platform winners, component players, or established companies with credible robotics strategies. The specific companies that win aren't obvious yet, but the trajectory is clear enough that this deserves attention, especially as we move from factory floors into logistics, service sectors, and eventually consumer applications. For now, this is a space that I'm going to be watching. I'll be looking at the cost curves, deployment numbers, and which partnerships actually are converting to revenue. Because I believe when this crosses from pilots to production at full scale, and the economics suggest that it will, the compounding effect will be significant. In less than 5 years, we might genuinely have humanoids handling domestic tasks at scale. And hey, that seemed like science fiction only 2 years ago. Now it's a question of timing and execution. Well, that does it for today's episode. I hope you enjoyed it. I will have a co-host with me next episode. Simon, our Mr. Beater, will be joining me. But thank you for listening. I'd love to hear your thoughts on the humanoid robots and whether or not you think you'll have them in your homes in under 5 years. Leave a comment if you're watching on YouTube. We'd also appreciate it if you could leave a rating and a review in your podcast app. But that does it for this episode. Thank you so much for listening. See you next time.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.